Again. It seems like every few months the crypto market decides to take a nosedive, leaving investors scrambling and headlines screaming. Let's talk about the crypto market, that ever so exciting yet often terrifying world of digital currencies. We'll dissect what happened, why it happened, and what it means for your digital investments. Imagine a toddler denied a third ice cream. 1 minute joy, the next, a meltdown, screaming, flailing, and utterly inconsolable. That pretty much sums up the crypto market's behavior recently. That's a market correction. When everyone suddenly remembers prices can go down. It's a harsh reminder that what goes up must eventually come down, sometimes with a vengeance. In early July 2025, the altcoin market, everything but Bitcoin, had a full-blown meltdown. A spectacular, no-holds-barred digital fire sale. It was a digital bloodbath. Portfolios tanked. Dreams of early retirement faded faster than you can say blockchain. Why the panic? The usual cocktail inflation fears, rumors of exchange trouble, and whispers of new regulations. A perfect storm of uncertainty. Like a Jenga tower, one bad block and the whole thing collapses. The crypto market, with its interconnectedness and reliance on sentiment, is particularly vulnerable to this kind of cascading failure. Popular altcoins like Solana, Cardano, and Dogecoin dropped 20 to 30% in days. Ouch. That's enough to make even the most seasoned investor sweat. Crypto is famously volatile. Think unicycle on a tightrope during an earthquake. It's not for the faint of heart. Investors with weak hands panic sold at the first sign of red, triggering a domino effect. One person sells, prices drop, more people panic, and the market looks like a food fight aftermath. Utter chaos and devastation. The optimism vanished, replaced by cold reality. The kind that slaps you in the face and tells you to wake up. The party was over, the music stopped, and everyone stared at their battered accounts, wondering where it all went wrong. But in the chaos, something strange was happening. A glimmer of hope amidst the despair. Not every coin was swept away. Some managed to weather the storm, defying the overall market trend. One digital asset stood out by doing absolutely nothing. While others plummeted, it remained remarkably stable, a beacon of calm in a sea of red. While the crypto world panicked, gripped by fear and uncertainty as established cryptocurrencies plummeted and fortunes vanished overnight, one asset just chilled, the PI token. It remained remarkably unfazed amidst the turmoil. A digital oasis of calm in a sea of red. The PI network lets users mine PI on their phones, making cryptocurrency accessible to a wider audience, far beyond the traditional tech-savvy investor. It democratizes the process, allowing anyone with a smartphone to participate in the digital economy. But it's stuck in an enclosed mainnet. You can't trade it on major exchanges. This limitation, while frustrating to some, inadvertently became its saving grace. It's like casino chips for a casino that hasn't opened. You can accumulate them, but you can't cash them out just yet. The potential is there, but the realization is still on the horizon. As other coins crashed, their values plummeting and their communities fractured, PI's value, at least within its community, held steady. It became a symbol of stability in a volatile market, a testament to the power of a closed ecosystem. No panic selling, no mass exodus. The community remained intact, a loyal base of believers who saw value beyond the immediate market fluctuations. Why? You can't sell what isn't for sale. The inability to trade on open markets removed the temptation to panic sell, a common pitfall in the crypto world. The very thing that frustrated users, its isolation, became its strength. It acted as a buffer, shielding it from the external market forces that were wreaking havoc elsewhere. The chaos outside couldn't touch it. It was like a fortress, impenetrable to the storms raging beyond its walls. PI pioneers calmly tapped their phones, continuing to mine PI, unfazed by the market downturn, insulated from the carnage. They were in their own world, a digital sanctuary protected from the financial apocalypse. Its value, based on community consensus, didn't flinch. It was a closed-loop system where value was determined internally, not by external speculators. PI was graded by its own hopeful believers, a community that saw potential in the project and remained committed to its long-term vision, not the market. Its valuation was insulated from the whims of traders and the volatility of the open market. It was a real-world stress test, and PI passed, not by innovation but by being walled off. Its unique structure inadvertently protected it from the market crash. Sometimes dumb luck is all you need to get noticed. In the chaotic world of cryptocurrency, being different, even unintentionally, can be a winning strategy. Meanwhile, Bitcoin, the king of crypto, faced its own crisis. It flirted with $120,000, but every time it neared that mark, it was smacked down. That price wasn't a finish line, it was a wall. As Bitcoin approached $120,000, massive sell orders from whales triggered, creating huge sell pressure. Imagine pouring water into a bucket with a hole. Buyers came in, but sellers drained it out. Billions in sell orders stacked up, making $120,000 an impenetrable ceiling. This failure sent a chill through the market. Bitcoin is the son of crypto. When it falters, altcoins freeze. The inability to break through signaled the end of bullish momentum. Fear spread and the final Jenga block was pulled. The king faltered and the altcoin floor collapsed. Bitcoin's ceiling became everyone else's trapdoor. Picture a seesaw. Greed on one end, fear on the other. For months, greed dominated, fueled by hype and new money. That's a bull market. Everyone thinks the party will never end. But seesaws move. When Bitcoin showed weakness, the balance shifted. Nervous investors jumped to the fear side, slamming it down. That's a market correction optimism flips to panic. Leverage and FOMO, which fueled the rise, now accelerated the fall. Forced selling and trading bots created a vicious cycle. Altcoins, the delicate flowers under Bitcoin's oak, were uprooted. Investors fled to safety, Bitcoin or cash. Altcoins fell hardest when the seesaw crashed. Let's dive into a fascinating comparison. Cardano versus PI token. We're going to examine how these two digital assets fared under similar market conditions, revealing some stark differences in their performance and community sentiment. One is a well-established player, the other an emerging contender. Cardano, a major project with significant market capitalization and real-world applications, experienced a sharp downturn, losing 25% of its value in just 2 days, a dramatic illustration of the volatility inherent in the cryptocurrency market. This rapid decline sent shockwaves through the Cardano community. Consequently, hundreds of millions of dollars vanished from Cardano's market cap, impacting investors and highlighting the risks associated with even the most prominent cryptocurrencies during periods of market instability. Trading charts turned overwhelmingly red, signaling a widespread sell-off. Panic selling gripped the market as investors rushed to cut their losses, exacerbating the downward spiral and creating a climate of fear and uncertainty. Now let's consider PI token. Unlike Cardano, PI token operates within a closed ecosystem. There's no public chart available to track its price movements, and it's not traded on any open market exchanges. This lack of external trading creates a unique situation. Despite the turmoil in the broader crypto market, PI pioneers, the users of the PI network, simply kept mining, accumulating more PI tokens through the app's mining mechanism. They continued chatting within the PI network community, discussing the project's future and reinforcing their belief in its long-term potential. And they kept a close eye on their balances, watching the numbers grow steadily as they mined more PI, seemingly unaffected by the external market fluctuations. For the PI community, the chaos unfolding in the outside cryptocurrency world was largely irrelevant, a distant storm that didn't directly impact their internal ecosystem. To illustrate this contrast, imagine two ships navigating a storm-tossed sea. Cardano's ship is out at sea, exposed to the full force of the storm, battered by relentless waves of market volatility and investor sentiment. In contrast, PI is like a ship safely contained within a bottle, shielded from the storm's fury and untouched by the turbulent conditions outside. PI's lack of open market access, a feature often criticized for limiting liquidity and price discovery, that very characteristic, its critics' main gripe, ironically became its shield, protecting it from the immediate impact of the market crash. As a result, PI holders experienced a unique, almost smug satisfaction, knowing their holdings were insulated from the market's turmoil. While their friends and acquaintances lamented significant losses in their cryptocurrency portfolios, the PI community confidently pointed to their project's apparent stability, a testament to its closed-loop system. Of course, critics are quick to point out that it's easy to maintain stability when your value remains largely theoretical and hasn't been tested in the open market. But for that particular week, during the height of the market panic, theory, with its promise of stability, felt undeniably safer and more appealing than the harsh realities of the market. Sometimes being stuck in a bottle, isolated from the outside world, is the best and perhaps the safest place to be, offering a temporary refuge from the storm. What's PI token's secret? It's not tech or partnerships, it's structure. First, the enclosed mainnet PI is locked away from public trading, so no wild price swings. No whales dumping, no panic selling, just a walled garden. Second, the community, tens of millions, many new to crypto, investing only time, not savings. They're patient collectors, not twitchy traders. The project is built on hope for the open mainnet, anchoring optimism. PI holders focus on the future, not daily price swings. Their conviction is about vision, not price. The system enforces hodling by design. PI's stability was no accident, it was structure and psychology. In the crypto storm, PI's cage was its shelter. Sometimes the safest place is behind the walls. So what's next? For Bitcoin, expect a breather sideways trading between $95,000 and $115,000. This gives investors time to regroup and build a stable base. Long-term, Bitcoin's outlook is bullish. Institutional adoption is growing and the next halving looms. For altcoins, the future is shakier. The crash reminded everyone not all projects are equal. Altcoins will follow Bitcoin's lead if it recovers. So will they. If not, more pain is coming. Now, quality matters more than hype. Investors will shift to projects with real utility and strong communities. The correction cleanses the market, leaving only the resilient. The after-party is where the real winners emerge. The big question, what happens when PI token finally goes public? Its isolation can't last forever. The open mainnet is coming. That's when PI will face real market forces. Millions may rush to sell, creating huge pressure and likely a price drop. Success depends on enough buyers and real demand. The PI core team is delaying launch until mass KYC and a robust ecosystem are ready. They want genuine demand for PI before it hits exchanges. The transition is a tightrope walk. Stability now is temporary. Will PI's community and utility hold up, or will it crash like the rest? Experts are split. Some see revolution, others see a ticking time bomb. One thing's certain, when PI goes live, everyone will be watching. So, what's the takeaway? The crypto market is not for the faint of heart. Corrections are panic attacks and altcoins feel it most. Bitcoin is resilient, but even it hits walls. PI token showed value can come from community belief, not just trading. Its cage status turned from frustration to superpower. Market structure matters as much as sentiment. This was a lesson in risk, structure, and psychology. Cardano faced the storm. PI was shielded, but that won't last forever. Crypto is high risk, high reward. The PI network's real test is still ahead. The market will recover, but the memory of this crash should remind us, know the risks before you dive in.